So most homeowners think that refinancing only makes sense if rates drop by a full percentage point, and that is outdated thinking. Even the smallest move in rates can open doors to strategies most people tend to overlook. And in this video, I'm going to walk you through the top 5 ways that we are turning tiny rate shifts into big financial opportunity. My name is Eric Hamilton. I'm a top 1% lender in the country, and I'm here to break through the noise, bring you real numbers, so you can act with clarity and not urgency. What I'm about to share is designed to help you cut through the noise, see the opportunities hidden in today's market, and know exactly what to help you benefit from a move lower in rates. Here's what I'm going to walk you through today. Number 1, how to cut the years off your loan without raising your monthly payment. The smartest way to understand a blended rate strategy, the hidden path to removing PMI and boosting cash flow, how to use your home equity for freedom and not stress, and how to stack savings most people overlook. And stick around because in the end, I'm going to do a bonus hack that I've been talking about with a lot of people that will save you thousands by keeping your payment exactly the same and taking years off your loan. So number 1 is very popular, was very popular in COVID, is shorting the term of your loan. So even a small dip in rates can make a 20-year or a 15-year affordable with only a modest payment change. So what you always want to ask is, obviously you can do another 30-year and that's very popular, but there's also a lot of options where you can do a 28-year. If you have 2 years into the loan, you can do a 25-year, you can do a 20. Ask your lender, and something we always do, to go through different, what are your goals? What are you trying to accomplish? Are you looking to save money per month, or are you looking to pay your loan off quicker? Do you have plans to sell in 10 years? Do your kids go to college in 8 years and you're trying to get in a better financial position? All those things will help us determine the best way to look at term, okay? Now, why do you want to shorten your term? Because it will help you build equity faster and it will save tens of thousands of dollars on interest. When we go through this with a potential refinance candidate, we'll go through and we'll say, hey, you're going to save $100 a month, but if you do this as a 25-year, your payment's going to go up $70 a month, but this is the interest savings over the life of the loan. And if you sell in 10 years, this is the difference in equity. And seeing that data on paper can help them make a much better financial decision. So always take advantage of that. This is what you want to ask your lender. What's my break even on cost? Too many times people are doing refinances today and their break even is 7-10 years down the line because the lender's throwing in a bunch of fees, points, so no money out of pocket, but their loan amount is going up $15,000, $20,000. More people get taken advantage of on a refinance than any other transaction. Also, can your budget handle the new payment? You may love the idea of a 15-year fixed, but does it fit in your long-term plans? How long do you plan to be in the home? Doesn't make sense to refinance a lot of times if you're going to be selling in a year or 2 or 3 years. You have to think about what your goal is and how long you expect to be in the house. The number 2 strategy that we're using is restructuring high interest rate debt. So we'll get a lot of calls. Eric, can I get an equity line? I need to pay down some debt. $60,000 in debt, $70,000, $80,000. We've had some over $100,000 in debt. Student loans, car loans above 10%, credit card rates 20, 30%. So what you want to really understand when you're getting a home equity line of credit, which is always an option, is that rate is going to be higher than a first mortgage, but lower than a credit card. So maybe in certain circumstances, a good option. But what I would suggest is you compare your current loan, a new cash out refinance, paying off all the debt, so you got one mortgage, and then a refinance, if that is an option, or just a home equity line of credit added on as a second mortgage. Now, this will help you consolidate credit cards, okay? Now, when you replace, and the reason why we look at cash out refinances and side by side, some people say, I have a 2.75, I have a 3.5% mortgage. There's no way I'm refinancing. But when we take and we look at $100,000 in debt and we look at an opportunity to combine that into one first mortgage and we look at their blended rate. So your blended rate is the most important piece of the puzzle. We look at all of the rates together, and if your blended rate is like 8%, 9%, that means your mortgage is 3, your car payments are 10, your credit cards are 30, and your blended rate is 8, 9%, then it makes sense to consolidate into one loan in a mid-6s, we have borrowers that are saving $1,400, $1,500, $1,600 in cash flow per month by doing a cash out refinance. They called us to do an equity line, but a cash out refinance made more sense. So don't, you want to be careful though, because you don't want to necessarily stretch short-term debt into 30 years. But financially, those conversations are good to have. And there's plenty of times we go through these strategies and the customer decides just to do a home equity line of credit, and that is fine. But always be careful. Set fixed, payment strategies to stay on track. If you're not going to pay down your debt, the debt is going to, affect your quality of life a lot more than people imagine. So make sure that you consider restructuring that high interest rate debt. So the number 3 strategy that we see a lot, and what's crazy is you don't even need to, I helped, 2 buyers that I helped over the last couple of years get rid of PMI, and we didn't even need to do a refinance. There's a process to get rid of PMI. We coach our borrowers how to do that, and reach out to the current servicer, and they go through this process. Typically, you have to have the loan for 2 years before you can do this, unless you've done a substantial amount of work. You reach out to the servicer, you say you think your value is over the 80%. The reality is, servicer's not going to reach out to you. They're not going to say, hey, Mr. and Mrs. Borrower, you have 20% equity. Let's stop paying PMI. They're going to get it for as long as they can. So leverage equity growth to cut mortgage insurance, sometimes without refinancing, okay? This is immediate monthly savings to someone. This could be $200. This could be $150. This could be $175. You pair that with a refinance, and that's when you can save a lot more than what people are expecting. So, if removal is not possible yet, okay, even a small refinance with a small rate reduction might eliminate enough of the ability to give you the savings that you're looking for. But if we can possibly lower your rate, by more than 0.5% and get rid of PMI, that could be a big enough savings where the break even is really fast. So the number 4 thing that we're seeing a lot of, and it's really a reflection of the economy, debt is at an all-time high, savings is at an all-time low. I work with a lot of financial advisors, and that is to tap equity in properties for cash flow. So, that could be investment properties that are owned free and clear. That could be a second home. That could be a primary residence. And it could be for emergency reserves. It could be for home projects. It could be for paying off that debt that we talked about. So we always have the option to do a home equity line of credit. We always have the option to do a fixed second mortgage with a fixed rate. But one of the strategies we're seeing a lot of is getting cash for other things. It could be an investment in another property. It could be student loans. It could be to send kids to school. We even have financial advisors that are looking to help with retirement plans. So they're looking at getting cash out of homes to put that money to market. I don't know how I feel about that, but that's what we continue to see. And it's a great strategy to think about. The number 5 strategy that we see is really probably the most important, and that's stacking savings. Okay, so think about it this way. If you pair refinance, okay, with these 3 things, and we've been doing a lot of this. So number 1, we're going to look at lowering the monthly payment with a reduction in the interest rate. So you have that savings. Then we look at homeowners insurance. We have homeowners insurance in specific states that have gone up 60, 70, 80%. So we encourage them, and we work with some great partners that will shop that out, and maybe we can save $50 a month, $75 a month. We look at their taxes, make sure they have their homestead exemption, and make sure that if they're a veteran in Illinois and you have a certain level of disability, you can get your taxes completely waived. It's shocking how many people don't take advantage of that, so we work with that. Then we also look at getting rid of PMI. So when you stack savings, we had a borrower last week that lowered their homeowner's insurance. We were able to add their homestead exemption. They never added it when they bought the home. Previous owner was an investment, so their taxes went down or will go down. They got rid of PMI, okay, and they lowered their rate. So the overall savings was well over $400. When they were talking with other lenders, it was like $70 a month with just the reduction in interest rate. So there are a way to stack savings, and the impact of this when multiplying savings can be huge. And that $400 a month could go towards principal, can go towards other debt, it can go towards investments, it can go to whatever you want. It could go to savings. one of the things that we encourage a lot of borrowers to do is to start maybe saving a little bit more. So the last thing I'll leave you with is, kind of a bonus strategy that I talk with and I suggest for every borrower if your finance allow for it. So the argument that a lot of people have always is let's say, hey, Eric, it's just not enough. I'm going to wait. I think rates are going to go down. And what I always tell them is, what if you refinance today, okay, and you continue to pay exactly what you're paying today, okay? So you're going to save $133 a month. What if you just continue to pay your mortgage? So let's talk about that. So the difference goes directly to principal, okay? And so instead of your payment dropping $133, you're just going to continue to pay exactly what you're paying today. So if you keep your current mortgage, you're going to pay your $2,600 a month, okay? Whatever the payment is, okay? But if you refinance and you lower your rate and you continue to pay that $2,600 that you would have paid no matter what, that $133 a month is going towards principal, okay? Apply that every single month and you'll pay your loan off 2 years earlier and save nearly $40,000 in interest, okay? So we can do that in a lot of different ways. Sometimes it's, we continue to pay exactly what you're paying now, and in 5 years when you expect to sell the house, you're gonna have $10,000 more in equity when you go to sell. That could be paying for your realtor. That could be paying for real estate taxes when you sell. So those are the types of things and strategies you want to think about. Lower payment savings is great, but one of the things that I saw the most during COVID was what people were taking shorter terms. People were, paying extra towards principal. They were taking that extra money and putting it towards principal. It's why the average loan to value in the United States is like 43%. So it's one of the simplest ways to turn a small refinance move into a huge win, okay? So these are the ways that I want to go through. Refinances are one of the ways that people get taken advantage of the most. So you want to know these things, okay? Number one, and I'll put a link in the bottom for this so you can take it, you can download it and have it with you. But best ways to avoid mistakes on a refinance. Number one, know your break-even point, okay? The lender can't answer that question. You want to run. Don't just fall for these things. Do you want to save $150 a month? I'll send it out. You don't need to do anything. Sign here. Those are, that's predatory lending in my books because you're not explaining the advantage of refinance and people get caught up in that. Calculate how many months it takes for savings to cover the cost. If you plan to sell before that break even, do not refinance. Number two, don't stretch short-term debt too long. So if you have 2 years left on your auto loan, you don't want to put it into a 30-year debt. Okay, so you got to be very smart about that. Look at the whole payment, not just the rate. Factor in taxes, insurance, HOA, PMI. A lower rate doesn't always help if the other items are going to offset that savings. Your taxes are going up. Whatever it may be, you want to look at the whole picture. Watch fees and closing costs. Can't stress this enough. I had a borrower, VA client, we were offering him a rate. He said, Eric, I just got another offer. I said, great, send it over to me. Let's take a look at it. I just want to make sure you're getting a better deal. If it's a better deal, I'll tell the client like, hey, this is great. You want to go for it. I've been doing this for 20 years. It's easy for me to provide that advice. The problem is I sent it over and it was about $15,000 in fees. The break even was over 10 years. It was just not worth it, okay? So compare lender credits, appraisal costs, title fees. Sometimes no cost, when they say that, just means no out of pocket, and they're just adding it to your loan amount. No cost is a gimmick that a lot of people are using, and it's not, you're either getting a higher rate or something, it's going somewhere. You want to compare apples to apples. Any lender can offer no cost. The best rate sometimes isn't the best option for you. Number 5 is protect your credit during the process. Don't open new accounts. Don't run up credit cards. Don't co-sign all the typical things. If you're using the money for something else, be careful what you're applying for. And then number 6, way to avoid a mistake is get multiple scenarios, not just one. Look at shorting terms. Look at a 20-year. Look at a 25. Look at, if you have 28 years left on your mortgage, ask if you can do a 28 years so you're not adding more years. The last one is most important. Who you work with matters, okay? Work with a pro who runs the numbers and can understand the break even and can give you good financial advice and will be there long after that closing to help you if rates go down and will put you in the best position. You don't want to pay a ton of points today to refinance. What if rates go down? Then you've wasted that whole thing. So you want to be careful on break even, work with a pro. So remember, in summary, you don't need a 1% rate drop to win. The right move is the one that advances your financial plan. Shorter term, better cash flow, and less interest. It's got to be all three. You can't sacrifice rates, okay, just to get the best terms. You got to have the lowest cost, the lowest new loan amount, and the best rate comparing all three. Don't just look at rate. Focus on quality of life and better money management. Okay, so if you found this helpful, subscribe, share with someone who needs it. Refinances are the area that most people get taken advantage of. So if you want to know if one of these strategies will work for you, just schedule time with us. I'll put the link in the description, and schedule time with me one-on-one 7 days a week. I'm available 7 days a week from 7 in the morning till 11 o'clock at night. Thank you.